And welcome into this week's market update. Don't forget that any advice contained within this presentation is general only, so it isn't tailored to your particular circumstances, and you need to decide for yourself whether it's appropriate to you. Okay, so we're nearing the close of our market today, and we've completely reversed earlier gains and closing fairly flat to a touch lower. The sell down was quite surprising considering the strength we saw in the US overnight. But we'll scratch on that a little bit more in a moment. Just from a technical standpoint, there is a bit of downward momentum that's been created over the last few weeks here. It looked like we were breaking through that this morning, but we're straight back onto that. It's a little bit of a short-term downtrend line, which means we're still inside a pennant pattern. Looking for that breakout higher. So that puts us back where we were very confident this morning on the open, looking likely to continue higher, looking likely to have continuation of the uptrend, now back into that level of uncertainty and going, okay, well, there's a bit of tug of war going in this market at the moment and a bit of sideways. So you can see here there's a clear reflection level here through 67.78 or 67.77. Thereabouts, we're back at that key reflection level. Not getting any strong signals now, and waiting to see once again what happens overnight tonight in the US. So from a technical standpoint on the XJO, sideways, short term, medium term, still bullish as we are on an uptrend. I do believe still that we're going to break higher eventually. It's just a matter of timing it, right? And that's what we're really trying to finesse at the moment, is that timing of the break higher. So talking S&P 500 at this point of time, last night looking quite bullish, a bit of continuation off the trend, a bit of signal there. We've got a bit of momentum back after a lot of sideways movement. That all starts to scream to me that we're going to break soon, okay? This big momentum down with the bounce, last time we saw that and bounced off trend, we saw a bit of continuation. So for me, there's a high likelihood of that happening in the next few weeks as well. But let's just see, right? US futures have turned into the red now. As we sit at the moment, you've got the Dow futures down 85, S&P 500 futures down 12 points. Not massive numbers, but that means we're going to give up a little bit of what we saw last night in the US. Not a strong sign of continuation that we normally see. What's got me a bit weirded out today, I guess, is the big turnaround through the Asian markets. Japan was up about 400 points in early trade, down 220, and that's where we saw a lot of the reversal in our markets through as well. So, most of the Asian region is heavily in the red right now. So, yeah, definitely the last night's optimism has shifted, and we're looking for strong reasons why, and I bet we'll find that out later through tonight in the US session. So let's sort of summarize why the US market rebounded a bit overnight. So the sell down we saw last week came heavily from nervousness of hyperinflation. There's still a lot of talk of that out there in the mainstream media. It seems to be the big talking point of the market right now. Whether we're going to burst the market's in a bubble and it's going to burst, whether the inflation's going to run away too quickly with all the stimulus that's being pumped into the system. So what that led to is a big sell down in the bond space. So we saw a huge amount of investors getting out of the bond space last week. Now I sort of rationalize this for a moment. When people sell out of bonds, the bond yields go up. Okay, so when people are talking about yields going up in bonds, it means people are selling out of that space, they're competing to get out, and the yields go up. If you're a buyer of bonds and the yields are going up, it means the price of your bond is going down and you lose money. Okay, so there's a rush to get out of the bond space. Now, why would investors be rushing out of the bond space? Let's think about that for a moment. Taking the US 10-year bond into consideration, if the Fed's targeting 2 to 2.5% inflation, if you hold a bond at 1.4% per year, you're losing money after inflation. So why would you want to be in that asset class when the central banks of the world, when the governments of the Western nations are all going to stimulate to try and create inflation. So what they're trying to do is bring inflation back into the system, and by investors jumping out of bonds, they're sending us a message saying, well, we think inflation's coming, why would we want to be in bonds? So message is clear, right? Most people are expecting some form of inflation to come back into the system. But it's by design, right? We need the inflation to bring us out of this recession that we've come into. We can blame COVID. We're heading that way before COVID anyway, if we all recall. But this inflation is designed to help us come out of the current recession we went into. So it's a funny thing, right? You're seeing in the short term a bit of negative reaction in the equity space on the back of this, where in fact it's actually very bullish to me in the equity space from a medium to long term perspective, right? Because if money's coming out of bonds, where's it going to go? All right, so it's something you need to think about here, guys, right? If money's coming out of the bond space, where's it going to flow next? Is it going to go into, people going to buy the US dollar? Are people going to buy Bitcoin? Are people going to buy equities? What are they going to buy with that money, right? I don't think it's going to flow back into the bond space, and that's why the central banks of the world have to do QE, because as people are exiting the bonds, someone needs to be the buyer. And that's what the RBA is doing, and that's why the RBA had to introduce more bond buying yesterday. So to summarize this a little bit, guys, they're selling in the bond space. People selling out because they believe inflation's coming back, and the yields that they're going to achieve off their current bonds won't cut it. Okay, they won't get enough out of that to cover the inflation, so they need to go back into something else that's going to give them a better return than inflation of 2 to 2.5%. So I do believe the 10-year bonds and long-term bond space have to go up more, right? But what we want to see as traders and for stability in the equity market, we want to see it done in a slow and steady and healthy way. The moves that we saw on Thursday and Friday of last week were too aggressive, which caused a lot of fear. So what we have to see is a slow, steady increase in that space. It means that it shows signs that the central banks have it under control and that we don't have anything to worry about in the short term. So what we might be seeing here is still a bit of nervousness there around what happened last week. I understand something that monetary policy is probably the biggest thing when it comes to what the equity markets do next, okay? And at any point at all, if the central banks become a bit more hawkish, that's where the market will pull back significantly. So let's have a look what happens tonight. Look, there's a bit of nervousness still there, but for me, overall, the market's still bullish. I think, you know, we are going to see that break higher eventually once we get past this nervousness. Biden stimulus is the next big thing. 1.9 billion worth of stimulus has passed the House. We need it past the Senate. It may struggle. I know they're talking about voting on it this week. It may struggle. There's a few sticking points in there that the Biden administration is trying to push through. In particular, the biggest thing everyone's talking about is the minimum wage increase. So that may hold things up. We'll soon find out. That's where a bit of nervousness might be as well. But ultimately, once that 1.9 billion is passed, a big part of that is the $1,400 check that's being sent out. That should be pretty positive again for in the short term tech and discretionary stocks. But overall, you know, we are in a very favorable position right now for equities as a whole. The recovery stocks should continue trending up over the next 12 months. In the short term, you get sort of a switch between different themes, the flavor of the week type stuff. We're seeing heavy buying in the tech sector this week. That could continue. Let's find out, right? Tonight's going to be a very telling night. RBA update today was fairly positive toned, saying that the recovery is on track. GDP is looking to get back to 2019 levels later this year, and then basically still nailing rates to the floor until 2024. Once again, this is all screaming positive for the housing market. It's screaming positive for the banks. It's screaming positive for equities as a whole. Okay, So from a central bank point of view, things are looking great for the market, and nothing's really changed. For me, there's a clear message here that there's an eagerness of the central banks to do whatever it takes. Okay, they will continue to just buy more and buy more and buy more bonds to keep that whole market robust and healthy, to keep people's fears at ease. So yeah, look, I think the right message is there, guys. It's just a matter of taking a bit of time for that to flow through again and get people's confidence up. Vaccine rollouts are going well. We just saw more news in the US over the last few sessions. We have the Johnson & Johnson vaccine that was approved this week. That's a 1-dose vaccine, and that's set to be rolled out pretty quickly through the US as well. So it's just another positive, guys. You've got, the central banks and the governments of the world have every excuse to stimulate at the moment. They can throw as much money at their economies that they want at the moment, until there's a problem with inflation. We don't have the problem with inflation yet. Everything that people are talking about right now is what could happen in the future, that there could be hyperinflation down the track, but it's not happening yet. The other part of the coin in all of this, and talking about the economic recovery and inflation, is you're going to struggle to get inflation across all parts of the economy unless you get a wage increases happening. So wage growth is still very weak, and without wage growth, then there has to be a cap on how far inflation across things can go. Asset inflation is going to be high. We're going to see housing prices go up through the roof. And we'll see other assets go through the roof, but food prices, and other things, it's going to be interesting to see what happens there, right? Because if people can't afford to buy it, then they're not going to buy it. So we need wage growth at some point. Okay, so there's a big conversation to be had around all that. That's for sure. But I guess my argument for equity markets right now is that as long as the economic data keeps showing only modest movements in inflation, I think the markets have still got plenty of upside. Once we see the hyperinflation, that's where you'll get the much bigger pullback. Okay, these small pullbacks we're seeing are really just pullbacks in the trend, guys, at this stage. All right. Okay, so not much else to say at this point. Thanks for tuning in. I think we've got a period of a bit of uncertainty in the short term here. Once we get past that fear, for me, everything's there for a bullish market, right? The trend's up, plenty of stimulus on the horizon. Things are looking pretty positive at this point of time overall. Okay, thanks again. Bye for now.